We also do full property inspections. We like to look at everything in the physical part of the building itself. How do the roofs look? How are the ACs? How are the furnaces? What about washer and dryers? How does the flooring look? What about the parking lot? All these things that come together for the property itself from a physical standpoint that'll help defer maintenance or help us point out things to be able to increase value on. Those are things that we look for in a physical inspection. And then we also do the due diligence on the financials. We get bank statements, reports, tax bills, and then we also get tax returns, lots of information from the sellers in order to determine whether or not this is actually what they've represented to us when we were able to get into contract. So these are really important things. Both of these items come hand in hand. And if neither one of these meets our criteria or cannot meet our standards for acquisition, we do not proceed in the deal. Then we go forward and negotiate contracts and financing. We like to get together with the broker and the seller and try to hash out the terms that work best for everyone. And then, of course, we have loans that we can sponsor for ourselves. You do need to sponsor the loan because generally in multifamily properties, whenever you buy a multifamily building, the lender is going to require that the net worth of all of the managers or manager needs to be equivalent or greater than the value of the loan being given. And that's just a collateral and a risk perspective. So we make sure that we can get our own sponsors so that we don't have to bring in other people to make this thing work. And then we take over the operation, the turnkey operation, and then put our business plan into motion for adding value right away. And then how do we finance the property? Well, since we find the ideal properties that fits perfectly into what makes a good deal, we have a good long-term relationship with many of the brokers. We do our due diligence. We have our financial underwriting that we do, and then we're able to apply for bank loans and get lots and lots of quotes. Then we'll help assume the liability, and then we'll create the opportunity, and then we'll operate this property for everyone. And then, of course, we also provide the capital, because if you yourself have $20,000 or $30,000 to invest, that's usually not enough to buy a very large apartment complex that is worth 5, 6, 7, 8, 9, or $10 million, because we'll have other capital, other people's money as well to pool in with you to help provide that opportunity to close on it. And then, of course, there's shared risk when it comes with not only you investing in the entire property yourself, but with a whole bunch of other people, including the managers themselves. So that shared risk is something that's very, very nice. And then how do we operate it? Well, we work with local managers who can manage the manager themselves. And we like to issue financial reports to partners, and then we do cash flow disbursements, hold regular webinar-based updates, as I was alluding to before. And then, of course, we visit the property on a periodic basis just to make sure that everything is running as smoothly as we like it to. And then when it comes time to sell the property, we do a whole bunch of different things, including marketing materials, talking to brokers, selecting a buyer, negotiating the contracts, closing, and then doing our final disbursement of the equity gains. And then, of course, at that point, that's when you have the opportunity to do a 1031 exchange and roll the profits from your current investment off into the next one. What I want to do is I want to get a little bit more into the nuts and bolts as to how properties are valued. And before I jump into a case study, I want to make sure you guys understand how a building is valued. Cap rate is one of the most important things when you're looking at buying an apartment complex, because cap rate is the ratio of the net operating income, which we talked about before, that is income minus expenses divided by the purchase price. That gives us a feel for what type of buy this property is. It doesn't include debt service, and it's a measure of profitability of an asset when we purchase it, without respect to how much leverage it is, because nowhere in that equation that you see is there leverage included. It's just how profitable is the building and how much is it to purchase that profitability. And that ratio is useful to compare because it helps us understand how much money our investment will be able to fetch us given the place that it's in. So if we assume that we have a property that's worth $5.5 million and the net operating income is about $552,000 per year, then that makes the purchase price a 10 cap. You take 552 divided by 5.5 million and you've got yourself a 10 cap, okay? The other important indicator to understand is called cash on cash. And this is more important as the investor to understand what this means. This means that for every dollar that you put out on the property, how much are you getting back in returns? Okay. So, how much cash flow are you getting for what we are putting out in terms of cash? And this number is represented as a percent, and it represents the true profitability or return of investment to the investor, to the individual investor. And this is important because it also does include the financing and the leverage, and it also is individualized as well to show, okay, this is how much money I put in myself, and this is how much I'm getting back. Okay. It's also very easy to compare this number to ROI with other investments as well. So again, let's assume that we have a $5.5 million building and we've invested $1.8 million in cash in order to purchase the building. So we have $1.8 million in as a down payment plus all of the reserves, all the cash that was needed to close. So if we have $216,000 worth of cash flow, that's after we pay the expenses from the income and also the financing. So after we pay the loans, we have $216,000 in cash flow, and then we put in 1.8 to create this $5.5 million opportunity. That means that for every $18,000 that goes in, I'm going to be able to collect about $2,000, which translates to a 12% cash on cash return. And that will happen every year as long as the cash flow or everything else doesn't change. Okay. Normally, cash flow increases over time, but what we'd like to do is take the cash flow that comes out each year and then take the average of all of them and broadcast that as the average cash on cash return over the 5, 6, 7 year hold that we're going to have on the property.